Hey everyone, let's jump right into this explainer. Today we're looking at the ultimate financial road trip guide to building long-term wealth. If you're a young adult just starting your financial journey, and especially if you're working with a pretty limited budget, you are in the exact right place. We're going to unpack some incredibly powerful strategies today that will literally take you from a stationary start to driving confidently toward financial freedom. Here's the roadmap for today. We're hitting why saving isn't enough, investing with little capital, the best ways to invest, the superpower of compounding, managing risks and taxes, and finally, common mistakes to avoid. Let's hit the road. All right, section 1, why saving is not enough, or as I like to call it, escaping the garage. So the very first step on our wealth building journey is understanding why just hoarding cash is a bad idea. Think about it like this. Saving your money is literally like parking your car in a garage. It's safe, sure, no one's going to scratch it, but you're not actually going anywhere. Investing, on the other hand, is putting that car in drive. Saving is great for an emergency fund. It's absolutely the first step. But if you want to build real wealth, you've got to put that money to work. Now, here's why parking the car doesn't work. Inflation. It's this invisible threat that quietly eats away at your money every single year. Let's say your savings account gets you a 3% return. Sounds decent, right? But if inflation is running at 6%, your money is actually losing purchasing power. You are moving backwards. So your real goal with investing is to outpace that 6% inflation and actively grow your wealth.
Moving on to section 2, investing with little capital, fueling up.
Okay, we need to completely bust the myth that you need thousands of dollars just to get in the driver's seat. Consistency beats initial capital every time. If you're on a tight budget, here is your playbook. Step 1, build an emergency fund first, about 3 to 6 months of living expenses. That's your bumper, protecting you from having to sell off your investments during a sudden crisis. Step 2, fractional shares. You don't need $1,000 to buy one expensive stock. You can buy a tiny slice of it for just $5 or $10. Step 3, use systematic investment plans, or SIPs. And step 4, this is a big one, automate your monthly contributions. Set it up so a small amount moves directly from your paycheck to your investments. You won't even miss it, but your future self is going to thank you.
Section 3, best ways to invest, choosing your vehicle. All right, we're fueled up, so what are we driving? There are 5 main vehicles to consider here. First up, the stock market. Things like index funds tracking the S&P 500. These are amazing because they offer low-cost diversification. Instead of betting on one company, you invest in hundreds at once. Second, real estate. If you can't buy a whole property, look into REITs, real estate investment trusts, which let you invest in property without directly owning buildings. Third, mutual funds, where your money is pooled and managed by pros. Great for a hands-off approach. Fourth, bonds. Think of these as lower-risk loans to the government or corporations. And fifth, cryptocurrency. High potential returns, for sure, but brace yourself for massive volatility. You know, every vehicle carries a totally different risk level, so pick the ones that align with your long-term goals. Section 4, the power of compounding, hitting the highway. Okay, let's shift into high gear. Compounding is absolutely the true engine behind long-term wealth. Actually, scratch the car analogy for a second. Let's talk about planting a garden. When you first invest, you're planting a seed. You water it, and it sprouts a branch. Those are your returns. But here is where the magic happens. Those new branches drop their own seeds, and those seeds grow. Over time, your one little seed turns into a massive, self-sustaining, exponential orchard. Just look at this timeline. If you invest just $100 a month at a 10% annual return, over 20 years, your wealth absolutely explodes because of compound growth. This proves that time in the market is way more important than trying to perfectly time the market. And what's the whole point of this orchard? Passive income. Whether it's from dividend-paying stocks, rental properties, or bonds, the absolute dream is to stop trading your hours for dollars. Imagine literally making money while you sleep. Waking up and realizing, hey, I just earned $50 overnight. That's the real power of letting your money do the heavy lifting in the background. Section 5, managing risks and taxes, navigating potholes and tolls. Look, no road trip is perfectly smooth, right? But we're going to reframe scary market dips as just speed bumps. You can't completely eliminate risk, and honestly, you shouldn't try to. The goal is to manage it wisely. How? Diversify across different assets so your eggs aren't all in one basket. Rebalance your portfolio annually. And, crucially, adjust your risk based on your age. If you're young, you have literally decades to ride out market dips, so you can totally afford to take higher risks for that bigger long-term payout. Finally, use dollar cost averaging. Basically, just invest a set amount consistently no matter what the market is doing. It really smooths out those speed bumps. Now let's talk about the tolls on this highway. Taxes. Smart tax planning is a game changer because it keeps way more of your profits in your own pocket. First, you need to understand capital gains tax, which is what you pay on the profit when you sell an asset. Then there's dividend tax on those regular payouts we just talked about. But here is the secret weapon: tax-advantaged accounts. These are special accounts designed by the government that give you huge tax breaks, letting your money grow either totally tax-free or tax-deferred. Navigating these tolls smartly is absolutely crucial for your final net worth.
Section 6. Common mistakes to avoid: staying on course.
It is insanely easy to let behavioral potholes wreck your journey, especially for young investors. Let's shine a bright light on what not to do. Here are the big 5 mistakes to avoid. 1. Investing without doing your own research. 2. Following social media hype. Seriously, guys, do not buy something just because it's trending online. 3. Trying to time the market. 4. Ignoring fees. Those little account fees will quietly eat your returns alive. And 5. A lack of patience. Honestly, all of these boil down to emotional decision-making. When the market crashes, fear makes people sell at the bottom. When it rallies, FOMO makes them buy at the very top. You've got to stick to your logical, long-term strategy and kick your emotions out of the driver's seat.
I absolutely love this quote from our sources. Remember, investing is a marathon, not a sprint. Market fluctuations and short-term losses are completely normal. Real, life-changing wealth is not built in a couple of weeks or months. It grows over years and decades of steady, boring, consistent effort.
And that brings us to the end of our explainer. We've mapped out the whole journey from escaping the savings garage to planting your compound interest orchard and navigating those pesky tax tolls. Just remember, the earlier you start, the stronger that compounding magic will be. So stop waiting for the perfect time, because the ideal moment is right when you choose to take action. Your future wealth literally depends on the choices you make today. So, what's your first move going to be?